Okay, good morning and an official welcome to our 7 a.m. Wednesday session. We're in week 3 now, so we're doing our second part of understanding financial statements. And next week, in 2 weeks' time, so next week is a break, everyone. So we're back together week commencing the 9th. And in that week, we talk a bit more about analysing financial statements, and we look at common size, for example, which is also in assignment 2. Okay, Tatiana's saying she has no audio. She's got some in her settings. I can override your settings, Tatiana. Let's see. Can you hear me now, Tatiana? Sorry, folks, just bear with us. Morning, Thomas. Just give me a minute, guys. I'll just give Tatiana a quick note whether she might need to log off and come back in. For some reason it's saying here that her audio is delayed. It's an odd setting. I've not seen that come up before. Okay. Okay, I'm going to have to keep moving. Yeah, I can see that, but I'm not sure. Let's just click on a few buttons here and see if I can't get this working. I don't know why. Okay. I'm just going to remove Tatiana from the room and ask her to log back in. So there we go. Hopefully she can log back in. So I'll make a start. We start off just doing a quick recap. All right. So we've been talking about the objectives of accounting, which is to provide information to facilitate decision making. We've looked at our accounting standards that have the force of law underneath the Corporations Act. You would have looked at a couple of the specific standards in your first assignment around fair value and also the agricultural standard that we talked about in our sessions last week as well. We've also talked about our listing rules for public companies and corporate governance. We talked about the 8 principles, the 8 ASX principles. Now, going further into those ASX principles, we have a session in your second assignment. Sorry, folks, falling over my tongue. In your second assignment, you'll be looking at Dick Smith's corporate governance statement. Now, it's on page 12 of their annual report. And when you look at it, it's pretty. It looks good. You think, wow, that's fully compliant. But when you start digging further into it, you might say, well, is it appropriate to have the CFO as a member of the audit committee, for example? Okay, Tatiana's come back in. Tatiana, can you hear me? Yes, excellent. All good. No problem. And I'm just going through talking about corporate governance, and that on page 12 of the Dick Smith report, you'll find their compliance statement with the ASX principles. And on the surface, you think, yep, that looks pretty good. But when you dig further, you might look and see and notice that is it appropriate to have the CFO as a member of the audit committee, for example? What does the principle suggest in terms of independence? How many independent people should you have on a committee or on a board? And independent means they don't work in the organisation. What experience does the board have? Is there diversity there? So you'll be looking at 4 of the 8 principles. Principle 2, which is structuring the board to add value. Principle 3, which is about acting ethically and responsibly. Principle 4 for safeguarding integrity in corporate reporting, and Principle 7, recognising and managing risk. And I think in our first week I spoke a little bit about Dick Smith and managing risk, and you look at the risk committee members. Who was on the risk committee, and is that appropriate? So that's the critical mind, that's the critical thinking that you'll put on, put your cap on, your skeptical cap. We've talked about the duality in the accounting equation. So there's always equal and opposite transactions. You do one thing, there's got to be something done to another account. We looked at the so assets equals liabilities plus owner's equity. So far we've looked at income statement and balance sheet. Today we go into cash flow statement. And we've also talked about cost in terms of historical and dare I say the word fair value. You guys are all now experts on the fair value phase. We've also talked about current and non-current assets and liabilities, so we go into that a little bit later in today's session as well. And we've done some liquidity and leverage ratios. And again, they factor into the second assignment. Okay, just a quick couple of questions, just a bit of a catch-up with everyone. What's been a key challenge? What have you found most challenging so far, folks? Yes, Thomas, yeah. The terminology is quite unique. It's like entering a new industry. I know when I moved from newspapers into healthcare, the terminology was just so foreign to me. It took me quite a while to wrap my head around what does that all mean. Yeah. Anyone here got kids or family? I know some of you do, because your names look familiar. Vince, okay, we're going to go more into cash flow statements today. So hopefully that might clear up any questions that you have. Yes? Yep. So everyone's sort of balancing work, life, kids, family. Well, hopefully you have a life. that study, life, work, family balance. Yeah. So we've got people that got sick kids. So we've had some notes about some sick kids, some kids getting in trouble at school. We've got people's bosses have resigned, so they're taking an extra workload there. So Roz and I are pretty flexible in terms of if you run into a problem and you can't hit a deadline, or you've got a question that you need to know the answer to, we're pretty flexible. Please just ask the question, and you know, in most cases we'll accommodate what we can, because you know, we're very cognizant of the fact that you guys have a life, you have families, and you have commitments. We're probably a little stricter with our undergrad students, but certainly in this space we're happy to be very, very flexible. What's some of the learnings from accounting so far? Other than this weird terminology that we have, and that we use words interchangeably. Yep, so the three main reports, our income statement, thanks Thomas, yeah, and how they relate to each other. We talk a little bit today again on how that links in from profit to balance sheet. Yep, thanks Tatiana, judgment. There's quite a lot about judgment. Thomas, you know more about cattle. Has anyone here turned vegetarian since doing the first assignment? Yeah, Courtney, learning how to apply it to business. Thanks, Vince. Yep, thank you for that. And any key takeaways at this stage? Well, that's one thing we ask you to think about in your reflective as well. I think most people's key takeaway has been that the estimation and judgment required, and that they have a whole new appreciation for cattle. Yeah, Vince, yep, digging deeper into reports and having that confidence to pick up an annual report and interrogate it. Yep. Oh, Thomas, yeah, the difference between revenue and cash. Yes, for large corporations, revenue is not cash because of our accrual concept. Thank you. Thank you for being open and discussing in the chat room. That's awesome. We'll jump in. Now, here's my very poor attempt at humour about one of the realizations that most people have at this stage is that accounting is not black and white, that there is a large amount of estimation involved. So with Australian Agricultural Company, they wouldn't be going out onto their land and counting every single cow. Asking, thank you, Courtney, for your little laugh there. So don't quite know where the cows might be. They use a lot of estimation to count them as well as to value them. And nothing about that is unethical, nothing is fraudulent. It's being sure that we can reliably measure. So they'll have records that have pregnancy records, that have branding records. And they'd rely a lot on those to look at the number of cattle they have and then apply a value to that number. So let's jump in and have a look. Oh, thank you, Tatiana. That's actually from Australian Agricultural Company. That is actually one of their plots of land and some of their cattle. I like the little cow at the front here. Anyway, we digress. Okay. So the statement of cash flow, what does that show? Well, it shows the inflow of cash to the business and the three main areas that comes from. So they've got cash flow from operating the business, they've got cash flow from investing, and cash flow from obtaining finance. So operating the business is receipts from customers and payments to suppliers and to staff. Investing is purchasing non-current assets and also selling non-current assets. And obtaining finance is debt or equity. So borrowings or paying back borrowings or raisings of capital. Okay, so I've just touched on both sides there, so it's the outflow of cash as well. So this is an additional slide, some activities that you see on a cash flow statement. So under operating activities, that's your day-to-day business. So cash from customers. So remember in prior weeks, I've sold some of you a television. So I'm Harvey Norman. I've sold you a television. I've said, thank you very much. You look trustworthy. You can pay me in 30 days' time. But me as Harvey Norman, I recognise that sale right now. Okay? Whereas I might get the cash from you in 30 days' time. In 30 days' time, that will appear on the cash flow statement. Payments to suppliers, so what it cost me to buy that television. It might have cost $500, and I may have had it in stock for a period of time. So I may have already paid the supplier. The supplier might have given me 30 days credit. I may have already paid them before I sell the television to you. Okay, so we talk a little bit later about this working capital concept and how cash moves around the cycle. Investing is buying or selling long-term assets and other investments, and financing is borrowing money from the bank, from a financier, or paying dividends, for example. So this cash flow statement answers a couple of questions in terms of, well, how was cash obtained to pay off our liabilities, so to pay off our borrowings, and to acquire new assets? So did we borrow money to pay off other borrowings? And that's not unusual, businesses do that. But did we borrow more than what we've paid off in other borrowings? And have we used those borrowings to pay for non-current assets? So park that for the moment, and then near the end we're going to come back to that thinking, and that's where we start our skeptical thinking around the Dick Smith statement. We also talk about how cash proceeds were from new shares, so how were they used, and also the position of the company. What is the position, and why has cash position decreased when a company has reported a profit for the period? And that is possible. So you can be very profitable, but have negative cash flow from operations, for example. So turning to that, we look at net cash flow from operating activities related to, but not the same as, profit. So remember, cash does not equal profit. Profit does not equal cash, because profit is measured on an accrual basis, Remember, I recognise the sale of my TV when I make that sale, not when you give me the cash. Right? And there's also this thing called depreciation. Depreciation is a non-cash expense. Okay? So if your working capital process, if you're a fast-moving consumer goods and you get payment for your sales fairly quickly, then your revenue and your cash is likely to be fairly similar. So therefore, usually a main difference between profit and cash flow is depreciation. Right? And generally, you would expect to see that your operating cash flow would be higher than your profit, right? Because your profit is reduced by the amount of depreciation. And I'll go through the Woolies statement shortly that illustrates that nice and neat. So with regards to the difference between cash and profit, there's a requirement for organisations to show a cash flow statement in their annual report. And generally people use the direct method, which is what we see in the Dick Smith account, and it's what's quite common across most companies, which is where they list the 3 areas of their cash flow, and then they list cash receipts from customers, payments to suppliers. But to work out those cash receipts, they undertake a little process internally where they look at converting their sales to cash. So they'll start with their sales, which is a combination of cash sales and credit sales. They will add back the opening accounts receivable, so what money was owed to them at the start of the period. They'll deduct what money is owed to them at the end of the period, and then the difference between all of that equals the cash that has been received during the period from their customers. Purchases is the same, right? They'll take into account the total purchases for the period, add back the amount owing to suppliers at the start, deduct the amount owing to suppliers at the end, equals cash paid during the period. And then to convert expenses into cash, they look at their total expenses, deduct depreciation, non-cash expense, deduct any other non-cash items, and that equals our cash expenses. So shout out if you have any questions along the way, folks. We move through this section fairly quickly. We're all good? All good? Okay. So having a look at the Woolworths statement of cash flow, this is from 2015. We chose this one because it demonstrates really nicely and neatly that difference that I was talking about before between cash flow and profit being depreciation. Okay, so this is their statement of cash flow, and we start by looking at, well, what was their cash from operating activities? Because that's what most closely relates to profit, okay, because it's the day-to-day business. It's cash from customers, it's payments to suppliers and employees, etc. So we note that it's 3345. And then we have a look at their profit for the period. Okay, 2137. So what roughly the difference between the two is that $1.2 billion mark. So hopefully I'll just flick back so you can see that. Now cash flow from operations is higher, which we said, yes, that's what we want to see, because profit is lower because there's depreciation included in it. Now, I haven't got the slide in here, but if you were to look at the 2015 Woolworths statement and look at note number 6, you see that depreciation is $1.1 billion. So the difference, as we've just determined, is roughly 1.2. So if you add the 1.1 back to the profit, because remember it's reduced by the depreciation, so we add it back, we come up with 3.2. So we're pretty close to our cash flow from operations. Does anyone have any questions on that? Is everyone okay with that theory? Clear? Excellent. Okay. All else all silent? I'll assume all is good if it's all silent. So that's okay. Yep, excellent. Thank you, Vince. Thank you, Thomas. So let's look again at the cash flow statement for Woolies and just consider some of the other items in there. So we had positive cash flow from operations, so that's a good sign. They're managing their working capital well. We have some borrowings. I've jumped down into the investing heading. We have some borrowings. We have some repayment of borrowings. Those numbers are fairly similar. So it's not unusual for a business to pay down their borrowings and then borrow for a longer period of time, so they've got mixed maturities on their loans so they can manage their cash flow. And they've paid some dividends, but the majority of that would have come out of their operating cash flow because they've got an excess of operating cash flow. We've purchased some property, plant and equipment, but we've also sold some. So part of these purchases of property, plant and equipment has been funded by selling some old property, plant and equipment. Other parts of it's funded from cash flow from operations. So overall, at the end of the period, we have a positive cash flow of 1,333. Okay, so that's all fairly solid, fairly nice and neat. Okay, so when you're looking at cash flow from operations, this is always a key area to look because this is running the business. Right? If it's negative, and look at, is the company acquiring assets? Right? If they are, how are they paying for those assets? So you look at debt. Are they acquiring more debt to purchase those assets? Then you look at that debt and you say, what's the term of that borrowing? Right? They've borrowed during the year. What's that term? Is it long term? Is it short term? If it's short term, and they're buying property, plant and equipment, which is a long-term asset, you've got a mismatch, right? Because that long-term property, plant and equipment will generate cash flows into the future, way past 12 months, whereas we've got to pay back that loan in a very short time frame. Okay, so again, park that, guys. We come back to that very soon. So a couple of warning signals, right? So assignment 2, you're looking for red flags and warning signals. If cash flow from operations is negative, basically means the core business is not generating new cash reserves. Okay, we might have money tied up in inventory that's not turning over very quickly, for example. We might have payments to suppliers and employees exceeding the receipts from customers. So again, that's negative cash flow. And if net operating profit is higher than cash from operating activities, then again, that could be a red flag. Right? How can a business, profitable business, not be generating at least as much cash as it is from expenses, right? So, in other words, they've got working capital tied up. Quick comment here on, did you purchase an asset or did you pay an expense? So sometimes it can be a little bit tricky to work out, well, what have I paid for? So we work through a bit of a decision tree. Has a cost been incurred? Yes. Is there a benefit to the business? Yes. Has the benefit been used this period? If the answer to that is yes, it's an expense. So a good example of that is wages. When you work or when your staff work for you, you've received the benefit of their time. Right, you've used up their time in this period, therefore that's an expense. If the answer to that is no, then we show it as an asset. We're going to use it up in the future. So if something is deemed an asset, we will depreciate that over its period of life. Right, so depreciation is not a valuation method. Fair value is a valuation method, but depreciation is not. Depreciation is merely taking the cost of our long-term assets and recognizing that they are used up over their lifetime, so we expense a proportion of their cost over their useful life. Okay, so it says here, it's not a fall. It is a fall in the. It's not a fall in the value of the asset. It's not a process of valuation. It is merely a process of spreading costs. So there's 3 main approaches. We have straight line, we have reducing balance, and we have units of production. So straight line is fairly straightforward. If we buy a $10,000 asset and we say it has a 10-year life, we will expense $1,000 per year as depreciation. Reducing balance method is where we depreciate a higher proportion of that asset in its earlier life, meaning that we're using up, or it diminishes in value earlier on in its life. For example, a car. You know, if you buy a brand new car and you drive it out of the car park, already it's dropped quite a fair percentage of its value just from driving it out of the car yard. And then that slows down over time. So usually an organisation will have straight line method for their book reporting or their internal reporting, and reducing balance method for tax. Okay, and that's permissible, that's allowable. The tax office is okay with that. You have reducing balance for tax because you get a tax deduction earlier on in the cycle. We can also self-assess a useful life. So an organisation can purchase an asset and self-assess how long it thinks it will be useful for. The ATO does provide guidelines, okay, and generally organisations work within those guidelines, because you know, the guidelines are there for a reason, and if you go too far outside of it, the tax office may want to know why. What would be, so let's just say we have an asset, $10,000, and we give it a useful life of 10 years. But let's just say at the end of year 5, it Hello folks, sorry about that, I don't know what happened. Can you all hear me? Okay, it seems like I've lost Wi-Fi. So I've just hooked into the data on my phone, so I'm probably going to chew up a fair bit of that. So apologies for that, the whole thing just throws up on us. So we were talking about if we had a $10,000 asset and after 5 years it's no longer useful. It's broken beyond repair. And we've said we've depreciated $5,000 of it so far. What should we do? What should we do as an organisation with that asset? Okay, so it's still got a written down value of $5,000. What do you think? Anyone prepared to have a go? No? Okay, what an organisation should do is dispose of that asset. Right? It's no longer useful, so we should dispose of it. And in disposing of that asset, we should also recognise the rest of the depreciation expense, right? That $5,000, and we'd recognise that in 1 year. Okay, so managers that are incentivised by a bonus that's tied to profit, for example, they may not want to do that. Why? Because they'll get a lower bonus, right? Because depreciation is reducing profit. So sometimes you might walk around in your building and poke your head out, the back into the warehouse or somewhere, and you might have some assets there that are sitting there collecting dust. Okay, and those assets possibly still have a useful life according to your depreciation records, but they're actually no longer useful, but you'll still depreciating them each period. Now, just quick to move the slides along. So looking in the textbook, it talks about choosing a useful life, and it's for Singapore Airlines, so page 19, and it talks about they changed the useful life of their aircraft from 10 years to 15 years. Right, so the longer the useful life, the lower the depreciation expense each year of that useful life. Right? And they decreased their expenses for 133 million for a 6-month period. And they also changed their residual value, so they reduced the residual value of their aircraft as well. So what they estimated they could sell them for at the end of the time frame, again affecting their depreciation and their profits. Anyone have any questions on depreciation, the importance of it, understanding it? No questions? Okay, I'll move on. So looking at our working capital cycle, we start from, let's start over here we purchase from trade creditors. So we're a manufacturer. I'll use my real life example from when I left university 25 years ago. My first job was in plastic injection molding, making parts for cars, so bumper bars, dashboards, etc. So we would buy our plastic pellets from our suppliers, right? And we were offered credit terms, so we could pay those in 30 days' time. We could pay for it in 30 days' time. So once we make that, raise that purchase order and we receive the goods, we have our raw materials in stock, okay, and they're an asset. We then have to pay our trade creditors. So this is, let's say, 30 days later, we've now paid our trade creditors. Right, notice we haven't got any cash in yet from our customers. We convert the raw materials, so we take the pellets, we put them in the plastic extrusion machines, and we have a work in progress. That is also an asset. Once it becomes a finished good, so we've now got a finished bumper bar, we now have inventory in stock. That is an asset. Right, and then Toyota, we then transfer the goods to Toyota. Let's say it's a bumper bar for a Camry. So we sell to Toyota and we say, thank you, Toyota, here's your bumper bars. So we will now recognise our revenue. And then we will say, you can pay us in 30 days' time. So generally 30 days means 30 days from end of month. So if you sell something on the 4th of the month, you won't get money until the end of the next month. So we finally collect the cash from our customers and the cycle goes around. So the ideal thing is to keep cash flow from debtors as closely aligned to the paying your trade creditors as possible. So the shorter that cycle, for example, places like Woolworths and retailers in general have a shorter cycle because of a lot of requirement to pay cash on delivery. You generally see their cash flow from operations fairly closely aligned to their profit. Okay, when you take out the depreciation or add back the depreciation factor. So some terminology. Working capital is our funds in current assets. Right, so assets that the entity expects to convert to cash within the next 12 months. Right, net working capital is current assets minus current liabilities. Okay, just a little bit of terminology. So why hold cash? Well, we've got to pay our bills, pay bills with cash. So it can be a precautionary motive. We may have some unexpected demands where we need to manage short-term risk, so we need to have an amount of cash in the bank. But holding too much cash can be a lazy asset. So it's really a matter of balancing, well, how much cash should we hold versus what our requirements are? Can we invest in the short-term money market to earn additional returns while still being able to pay our debts as and when they fall due? So accounts receivable, to give credit or to not give credit. So organisations need to make a decision as to what customers they're going to allow to pay them at a later date after they've already performed the work. Okay, so when you're assessing credit risk, what sort of things would an organisation look at? What do you think? So if you're Harvey Norman and someone comes to you and says, I'd like some credit terms, please, I want to take my stock now, what are you going to look at to make sure if they're going to be a good credit risk? Yep. So their ability of the customer to pay. How would you work that out? Vince, great point, and Luke. how would you know that they're able to pay? What might you want to see? References? Yep, perfect, Vince. Yep. So generally your request for credit form will require your potential customer to list at least 3 referees that they've had credit with before, and then you contact those referees to work out have they paid on time. You can also look at their credit registers. If they're a public company, you can also look at their annual report, and also consider the general economic conditions. You might also think about, what if I don't offer credit to this customer? Am I in a fairly competitive industry where if I don't offer credit, might they go somewhere else? And then what's the risk of doing that? So the risk is, when you're offering accounts receivable, is that the customer may not pay. So to be prudent, each month you'd assess, well, what has been our defaults historically, and if they were 1% of your revenue, then each month you'll allow 1% of your revenue as an allowance for doubtful debts. That will come through your income statement as an expense, and then forms a bucket of money, for want of a better word, in the balance sheet. And if someone does default, then you allocate that default to the balance sheet, rather than having a lumpy income statement of writing off debts as they happen. So when we're analysing our accounts receivable, so you'll be using these, doing some calculations in assignment 2, we look at efficiency ratios. So one efficiency ratio to look at is this accounts receivable turnover. So how quickly are we collecting cash from our credit customers? So the first formula is the sales divided by accounts receivable. Now, in your assignment, you are given the calculations we would like you to do. You're given the formulas. And the formula for accounts receivable turnover is asking you to use average accounts receivable. So average accounts receivable means you take the 2 years in the balance sheet, add them together, divide them by 2. Okay, so use the formulas in the assignment sheet. This is to demonstrate to you that there are different formulas for each ratio. Okay, so please use the ones in the assignment sheet. And then you'll look at, well, what's the number of days outstanding? Right, so the first one tells you how many times have you turned over your accounts receivable balance. The second one's asking you to look at, well, how many days on average have receivables been outstanding? And the formula you'll use is this one down the bottom here, which is 365 days, number of days in the year, divided by your turnover ratio, which is the one you've calculated at the top. Okay. Ideally, we'd use credit sales in the formula, but we're not given that information. So we use the turnover to calculate our number of days outstanding. Okay. And if that exceeds what you expect to reasonably see, so in retail, you'd expect it to be fairly low, like less than 30 days, because you've got a lot of cash on sale customers. Inventory, why do we hold it? Basically to service customer demand. If we don't have it, we may lose a sale. But what can happen, folks, if we have too much of it? What's some of the risks of having too much stock? Absolutely, Vince. It can become obsolete, right? And particularly in organisations with technology, obsolescence is a very high risk of holding too much inventory. That's okay. We also risk losing it, or theft, damage. There's also costs to store it. And if you're dealing with things that spoil, so food items or special types of drugs. So last night I had a pharmacist on the line, and she spoke of they have to have certain drugs in stock, and I remember this from my hospital days. You have high-cost drugs that you have to have in stock should someone present requiring that drug. Pharmacists used anti-venom, snake anti-venom, It can be quite expensive, but you have to hold it. And then, of course, it has a shelf life, right? So once that shelf life has passed, you have to dispose of that. So that's the cost of those sorts of businesses. Just a fun fact for everyone. So looking at that inventory turnover, so another efficiency ratio. Same concept. We use our cost of sales divided by our inventory. In the assignment, you're asked to use average inventory, so that's the 2 years in the balance sheet for inventory. Add them together, divide them by 2. And then you look at days inventory held. And again, we're using this formula at the bottom, which is the number of days in the year divided by our inventory turnover, which we've calculated at the top here. And you might find something very interesting in that, that it might be 100 days of holding inventory, which you would think in an organisation, in a retail organisation, that might be a little long. So this is a nice summary of what we've been talking about with working capital and the cash cycle. So for those of you that are visual learners, over here on the left is where we've purchased our inventory on credit. That's where we bought our plastic pallets in my example. Then we've paid for them. Then we've finished making the bumper bars and we've now sold them to Toyota, and now Toyota has paid for them. So between the purchase of the inventory and the sale of the inventory is our inventory turnover period. So they're the 2 ratios we just looked at. And then in between the payment for the inventory versus when we sold it and when we got the cash for it, that's our cash cycle. So managing accounts payable is important. That's when you're paying your suppliers. The videos online talk about credit from suppliers is like free money. And it can be, provided you use it efficiently and effectively. There's some risks associated with it. You might miss out on cash discounts. If you don't pay, you might end up with a bit of a bad reputation. Okay. Last night I had comment from people saying some larger organisations use smaller organisations as their source of credit, so to speak. And I likened that to the construction industry. I went to a breakfast the other morning and I listened to some liquidators doing a presentation, and they spoke about construction industry on the Gold Coast and companies that had gone broke, and that the poor people that suffered as a result of that were their tradies. So they were using their trade, the smaller companies, the tradespeople, paying them 60 days plus while still operating their business and running the show, so to speak. So it can be a challenging space. Quick look at Dick Smith. Okay, so does anyone have any questions on what we've covered so far? So I'm now going to apply some of that, okay, and apply it specifically to the Dick Smith statements. So hopefully everyone's got pens and papers handy, but this is recorded anyway, and it's still recording, so everything will be fine. There'll just be a bit of a gap in it from when my Wi-Fi dropped out. So this is their income statement. We have our revenue, we have our cost of sales, and then we have our gross profit. So gross profit is the excess of what I sold my goods for versus what it cost me to buy them. Okay? If it was a manufacturing company, it would be versus the cost of what it cost me to manufacture them. Right? At Dick Smith's a retailer, they're a merchandiser. So the revenue could be the $1,000 from the television that I sold to you all, and then the cost of that could be that it cost me $500 from my supplier. So my gross profit in that situation would be $500. Okay. Now this gross profit has to then cover all of our other expenses to run the business. So we have marketing and sales costs, we have our rent, our occupancy costs, our admin costs. So in amongst admin would be depreciation. Most organisations don't call that out separately in their annual report, but you can find it by looking at the notes against the property, plant and equipment in the balance sheet. It tells you the depreciation. And then we have our profit for the year. Okay. Now someone noticed something last night. that I'll draw to your attention is have a look at this finance cost year on year. Right? Prior year it was 2.854, then it jumped to 4.111. What might that imply? What could that imply, folks? What could you think about when looking at that? So finance cost is interest. The majority of it's interest. It's what it's costing us to service any debts that we have. Yeah, Thomas, you're right. They've incurred more loans. So just by looking at this one statement, you start to think, oh, hang on, what's going on here? It looks like they've borrowed some more money. What have they done with that money, right? Is it long-term? Is it short-term? Have they paid for assets? Have they paid dividends? What have they done with it? So to know that, we start by delving further into their balance sheet, and then we go and look at their cash flow statement. Having a quick look at the balance sheet, what jumps off the page to you? What, other than down in our equity section, in our assets and liabilities, can you see one number there that's quite large? And if so, what is it? Yep, Vince has noted trade payables. Yep, trade payables is quite high. So that's monies owed to suppliers. What else is quite high? If that's the case, then what else would you look for to be quite high? Yep. Okay, Vince has noted borrowings. Yeah, we'll come back to that one. That is a very good point. That's very relevant. But Thomas has mentioned it here, that inventory. Inventory is quite high. And what's one of the ratios we're getting you to calculate is inventory turnover. Right? So how quickly are they turning this into revenue, right, into cash? Like how quickly are they turning that over? Because to be able to pay all of these liabilities down here, short and long term, they need to turn over their inventory fairly quickly to get the cash flow moving through. Okay? Having a look at their cash flow statement, what's one thing that hopefully jumps immediately off the page to you? Yep, thanks Vince. Negative cash flow from operations. Let's jump back to their income statement. Look, they made a profit, but they made a profit. But remember we said earlier, profit doesn't equal cash. And having a negative cash flow from operations can mean that perhaps they're not managing their business correctly. They're not managing their cash flow correctly. Okay? Let's just look a little further. Right? So could you look on the surface of it, receipts from customers is higher than payments to suppliers and employees. So based on those two, okay, that's fine. But then we've got this interest. Remember back in our income statement here, we've got this finance cost. Into our cash flow statement, there it is, paying interest. We've also got a rather large tax bill. What else have we done? How have we paid for that? Given we've got negative cash flow, how have we paid for that? Well, we've paid for it from borrowings. Okay, see here, this 122,500. But have a look at the repayment of borrowings. We've only repaid 52, but we've borrowed 122. So why have we borrowed so much more than what we've repaid? Remember the Woolworths statement earlier? They repaid a similar amount to what they borrowed, so that's just making sure the maturities of their loans and their borrowings are being managed. But what have they done here? Well, okay, they've paid some dividends. Oh, sorry. Thomas has just noted the tax bill is large compared to the previous year. Sure is. Yep. So I haven't looked into detail as to what might be driving that. They might have had some capital gains. They might have sold some equipment or something and had some capital gains at some point that have been unrealised. That's a good point. So looking at dividends, so why would Dick Smith want to have paid dividends? Why is it? What does that signal? Yeah. Yeah, Australian company, we have Australian investors, yep. Like shares with, yes, yep, Australians like shares with dividends. Yep, investor confidence, yep, you're right. You're both, Thomas and Vince, thank you. It's sending that signal to the market that we are confident in the future of our business. Look at the prior year. They didn't pay a cent of dividends. Okay, and dividends are paid out of cash, right? They are provisioned out of profits, right? So you profit, you have revenue minus expenses equals your profit. You can then distribute some of that profit to your shareholders and then retain some under owner's equity as retained earnings, right? So that's provisioning. But paying it, you pay it in physical cash. So Dick Smith have borrowed money to pay some dividends. What else have they done? They've bought more assets. Sometimes that's not a bad thing, but then you look at, well, property, plant and equipment is long-term assets. So our return on that investment is going to be in longer than 12 months. So when does Dick Smith have to repay these borrowings? Let's have a jump back into their balance sheet and have a look at their liabilities. And tell me something you notice that looks a risk to liquidity. Okay. Where are you seeing borrowings? Under which heading? Are they current or non-current? Current. Yep. Thanks, Thomas. Thanks, Vince. What does that mean? When do they have to repay it? Yeah, a few people typing. Yep. Yep. Spot on, guys. They have to pay that back in the next 12 months. Right? So what are they going to rely on to generate those cash to be able to repay those borrowings and the interest associated with them and these trade payables? They need to turn their inventory over quickly. But when you look at their inventory turnover ratio, you'll notice that it was over 100 days. Right? So it's quite long, and that can, all of these are red flags to indicate that a company may be under financial duress, financial stress. Okay, so I'll pause there for a second and see if anyone has any questions. Hopefully you found that fairly useful going through the statement itself. Also note at the end they had positive cash, but again that's because it's from borrowings. Okay, so overall their cash was positive, but majority was borrowing. So they were gearing up the company. They were putting the company under a high risk situation because borrowings have to be repaid, whereas equity does not. Does anyone have any questions? Comments? We're all okay? Can I get tick? Is everyone still there? Susan, Tatiana, Thomas, Courtney, we're all good? Yep. Can you give me an indication that makes sense? You're comfortable now, you feel more confident to go and have a look at the Dick Smith statements and do some calculations and understand what it is you're calculating. That's fine. I don't mind. People like to listen. That's all good. That's what I'm here for. So thank you. Okay. If you have any questions, please make sure you email. I'll be stalking the emails fairly regularly over our break next week. So we all know we've got a break next week for Easter. I think I said that. Yep. Just our last slide. Just a reminder, at the end you've got a reflective journal to do, and it counts towards 4% of your overall grade. You can do it each week as you go along, or reflect back once you get to the end of the third assessment. It's compulsory to lodge a reflective. We can't release results without it. And provided you demonstrate that you've thought about the questions we pose and that you're reflecting upon your learning experience with us here over the last 6 weeks, it's a pretty easy 4%, folks. So I definitely urge you to take that into consideration and do that at the end and give it some good thought. But if we have no other questions or comments, I'll call it a morning. Thanks, Thomas. And I wish everyone a happy Easter. Okay, a happy and a safe Easter for those of you that are travelling. And for those that live on the Gold Coast, that are going into hibernation for the Commonwealth Games, that will be me. Thank you, everyone. I'll see you all on the week commencing the 9th of April. And keep an eye out on announcements for when we release the Assignment 1 results. Okay, thank you everyone. Have a great day. Have a great week and a bit. Hope you get lots of chocolate from the Easter Bunny. Stop the recording now.